Right now, what you're seeing in metals looks like the beginning of a crash. But if you understand how liquidity actually moves through markets, you'll realize something most people don't. This kind of dump is often how a liquidity reset starts. And if that's what this is, then the idea of a 2026 markets collapse might have just gotten canceled, not because the risks vanished, but because the pressure is being rerouted. Gold, dumping. Silver, dumping. Copper, dumping. On the surface, that looks scary. It looks like the entire hard asset story just failed. But one violent move does not mean the story is over. It means big money is doing what big money always does: shake the tree, force weak hands out, and buy back cheaper. Let me explain this in simple words because this is exactly where retail gets emotionally hijacked. Silver just dropped $7.45 in a blink, about 8%. Gold hit a fresh record, then people took profit. Copper tagged a record too, then it pulled back. If you only know the market from the outside, you see that and you think, that's it. Top is in. Everyone is rushing for the exits. But the people who actually move size don't think in one candle. They think in positioning, flows, and forced behavior. They ask one question: was this selling voluntary or was it forced? Because voluntary selling is a change in belief. Forced selling is just mechanics. And when you can tell the difference, you stop panicking at the exact moment the professionals are getting excited. Now look at what is actually pushing this dump. First, forced selling from index funds. There is an annual commodity index rebalance happening right now. In normal person language, here's what that means. Huge passive funds that don't think, they just follow a rule book, must sell certain commodity exposure for a few days. Not because they suddenly believe gold is bad. Not because they suddenly believe silver is over. Not because copper demand disappeared overnight. They sell because the index tells them to sell. It's not emotion, it's rules. And rules-driven selling creates a very specific kind of price action. Sharp, mechanical pressure that looks like fear, but isn't fear. It's like a forced exhale. If you're watching a chart without understanding flows, this is exactly where you'll misread the market, because you'll assume the selling is telling you something fundamental broke. But nothing broke. A rule triggered an order. And when enough size hits the market in a short time, price moves fast, especially in commodities, where liquidity can be thinner than people realize during certain windows. Now, the second driver is even more important. Banks are on the other side. CFTC data shows banks are net short a lot of paper metal. Let's make this concrete because this is where it stops being a theory and turns into a map. Silver. Banks are short 65,865 contracts versus long 25,723. That's net short 40,142 contracts. That's about 200.7 million ounces of paper silver. Gold. Banks are short 260,475 contracts versus long 42,197. That's net short 270,578 contracts. That's about 21.8 million ounces of paper gold. Copper. Banks are short 35,282 contracts versus long 32,506. That's net short 2,076 contracts. That's about 71.9 million pounds. Now here's the simple question that matters when metals dump fast. Who profits? The shorts. And who are the biggest middlemen banks in this market? The names that consistently sit in the flow, act as counterparties, and manage the paper exposure. JP Morgan, HSBC, Citi, Goldman Sachs, Morgan Stanley, UBS, BNP Paribas, Standard Chartered, Merrill Lynch, ICBC Standard, TD, names you already know. Now connect the dots. Metals go vertical. Banks are short. Passive funds are forced sellers, so price gets forced down fast, and that's exactly how you get a candle that makes people feel sick. Silver from $93 to $86. In a move like that, the market isn't voting on the long-term story in real time. The market is processing flow. It's processing forced selling, meeting a market where large players are already positioned to benefit when price snaps down. This is why you can't just look at the candle and think you learned the truth. All you learned is that size hit the tape. So now the question becomes, okay, if that explains the dump, why on earth would this be bullish? Because dumping metals can free liquidity. That sounds backward, but it's one of the most important concepts in macro and cross-asset trading. When people close metal longs, whether it's because they got stopped out, because they were forced to rebalance, or because they're taking profit, cash comes back. That cash doesn't disappear. It rotates, and when the forced selling ends, the mechanical pressure stops. So you often get this sequence. A vertical run-up creates crowded positioning. Banks sit short on paper exposure. Passive funds hit rebalance windows. A sharp dump flushes leverage and weak hands. Liquidity is freed. Then money rotates into higher beta, risk-on assets, into stocks, into crypto, into the more risky stuff. And that's why these violent commodity dumps often show up right before risk rips. Because the market is not one story, it's multiple pools of capital moving between containers. If commodities are the container everyone crowded into for safety and inflation protection, and then you get a forced unwind, you can get a temporary release valve that boosts the very assets people were too scared to hold. This is why you need to watch the flows, not the narratives. Flows tell you what the big money is doing. Narratives tell you what people want to believe after the fact. So what do you watch next? You watch whether silver and gold start bouncing while the bank short side stops growing. That's the signal. If metals bounce and at the same time the bank short position stops expanding, meaning the pressure from that side is not increasing, then you're seeing stabilization. And stabilization after a forced dump is often the moment the next rotation starts. Because once the selling that had to happen finishes, the market is suddenly free to trade what it actually wants to do next. Now understand how brutal this is emotionally. Retail sees dumping metals and assumes the entire system is collapsing. But the people who think in liquidity see dumping metals and ask, is this a flush that resets positioning? And if it is, that flush can be the thing that relieves pressure across the whole complex. That's why the phrase liquidity reset matters. A reset doesn't feel good. It feels like betrayal. It feels like the market is punishing you. But resets are how markets clear. They clear leverage, they clear crowded positioning, and they create space for the next move. And that's why the idea that 2026 markets collapse just got canceled is plausible within this framework, because sometimes what looks like a collapse is actually a pressure release that delays the real break. If you remove stress from one place, the system can run hotter somewhere else. Metals dumping can be that removal of stress. It can be the thing that re-energizes risk. Now, I want to be very precise with the takeaway, because if you misunderstand it, you'll do the wrong thing. This dump does not mean the story is over. This dump means the market is playing its oldest trick. Shake the tree. Force the weak hands out. Make it feel like the top. Then buy back cheaper. And if you want to stop being the person who always reacts at the wrong moment, you need to watch positioning and flows, not just price. Watch the forced selling window. Watch what happens when it ends. Watch whether bank short positioning stops growing. Watch whether metals start to stabilize and bounce. Because if that happens, the rotation can be fast. Stocks can rip, crypto can rip, risk can surge, and the people who got flushed out will sit there watching the move happen without them, telling themselves they'll wait for confirmation until confirmation is too late. I've studied macro for 10 years, and I called almost every major market top, including the October BTC ATH. Follow and turn notifications on, because I'll post the warning before it hits the headlines. Powerful clickable title, 2026 market crash canceled? The metal dump is the liquidity reset nobody understands.